are two main boards for organizing accounting as we know it now, which are: number 1, the International Accounting Standard Board, IASB, previously known as the International Accounting Standards Committee, IASC. Number 2, the Financial Accounting Standard Board, FASB. Let's get to know more about what they offer as well as some information about their history. And starting with the International Accounting Standard Board, IASB. The IASC was originally set up in 1973 and was the sole body to have both responsibility and authority to issue international accounting standards. And in February 6, 2001, the IASB was introduced, which replaced the IASC, which from that day until our current time is still organizing the accounting standards from its base in London, England, introducing the International Financial Reporting Standards, IFRS, which is adapted by more than 100 countries worldwide, with the main goal of ensuring that accounting standards have a consistent approach to problem solving. On the other hand, we have the Financial Accounting Standard Board, FASB, introducing General Accepted Accounting Principles GAAP. Founded in 1972, operational since 1973, the origin of GAAP goes way back to 1929, and the stock market crash that led to the Great Depression, and we will discuss more about the Great Depression in one of our next episodes. It's created to establish and improve financial accounting standards in the private sector. Located in Norwalk, USA. The difference between GAAP and IFRS. First, rules versus principles. GAAP is rules-based, which means that it is full of very specific rules for how to treat a large number of transactions. The rules basis also results in very large standards, so that the text of GAAP is much larger than the text of IFRS. IFRS is principles-based, so that general guidelines are set forth, and users are expected to use their best judgment in following the principles, and that is one of the main reasons why the USA is actually using GAAP, while it was easier for most of the countries to adapt with IFRS and personalize it according to its needs. Second, LIFO inventory. GAAP allows a company to use the last in, first out method of inventory valuation, while it is prohibited under IFRS. LIFO tends to result in unusually low levels of reported income, and does not reflect the actual flow of inventory in most cases. Third, fixed asset valuation. GAAP requires that fixed assets be stated at their cost, net of any accumulated depreciation. IFRS allows fixed assets to be revalued, so their reported values on the balance sheet could increase. The IFRS approach is more theoretically correct, but also requires substantially more accounting effort. We have noted some of the more significant differences between GAAP and IFRS. There are hundreds of smaller differences within each of the major topics of accounting, which are constantly being adjusted as the two standards are updated.